Good morning. It's Jeffrey Christian of CPM Group. It's 10:30 in the morning on Tuesday, the 11th of February here in New York. I want to talk about central banks and gold and some of the myths surrounding the gold market right now. And then I'll give a market update and outlook for gold and silver. Before I jump in, I wanted to say one thing. Investors who are buying gold and silver at today's elevated prices, based on the idea that London is running out of gold and silver, you will lose money on a short-term basis buying at these levels based on that misinformation. It's just something that you should know. The next thing I want to talk about is, I keep seeing these headlines. Central bankers know more than gold more about gold than investors, and the theme is that central banks are buying more gold than ever before. They're hoarding gold. They're moving from the dollar to gold, and investors ought to too. Well, central banks may not know more than investors, but they do know how to be value investors. And central banks, this chart here shows you the monthly gross purchases or additions to central bank holdings in the yellow, gross reductions to central bank holdings in the red on a monthly basis, and the black line is the net additions or reductions that you see. And the data is skewed right now by the fact that the Russian central bank is buying and selling gold on a monthly basis. And I've shown you charts of that in recent videos. So you see a lot more selling, and you also see a lot more buying because the Russian central bank is using its gold reserves to finance the government and to finance the war effort. But including that in there, you can see increased volatility. You can see several months over the last 2 years, 3 years now. You can see, 2, 4, 6, 7, 8 months where central banks were net sellers. That's a reflection of the Russian central bank primarily. But you can also see broadly that since early 2023, the first half of 2023, the gross purchases or additions and the net additions have been declining. And that is a function of two issues. One is higher prices. As gold prices are pushed higher by investment demand, central banks buy less gold. To some extent, that's because they're looking at the dollar value of their monetary reserves, and at a higher price, fewer ounces equal the same value. But it's also a reflection of the fact that central banks, generally speaking, are long-term buyers of gold and other currencies, and they're value investors. And as the price goes up, as investors push the price higher, central banks often and tend to pull back and wait for lower prices. We saw that in 2023 when central banks, the People's Bank of China, stopped buying gold in 2019 and didn't start buying until the price had fallen from $2,040 in the first quarter of 2023 to $1,640, giving up about 20% of its value in November of 2023. So, yeah, central banks may know more than investors. And if investors want to take a cue from central banks, they should probably be scaling down their purchases at these record prices. That's the monthly data. This is the annual data. Again, you can see a very broad trend. Central banks have been buying around 10 million ounces on average over the last 15 years. And they continue to buy gold, but they rather buy gold at a lower price. So if you want to take your cues from central banks, probably want to scale back some of your purchases. I have a number of things, and I listed them up front to talk about in terms of the Trump, well, they call it flooding the zone. They're just throwing all kinds of stuff out, from major destructive things like international tariffs, willy-nilly, that will probably lead us into a recession, tip the world into a recession, as well as increase inflation, to little things like getting rid of the penny and paper straws and probably toilets that are energy efficient or water efficient. So they're flooding the zone with stuff to try to overwhelm people. And part of what they're flooding the zone with is financial nonsense. So, and Trump seems to like sort of think of something maybe while he's on the toilet, and then he throws it out. So a couple of days ago, he said, well, maybe the U.S. government should have a sovereign wealth fund like other governments have. That's probably not quite that good. He's also said that pretty soon they're going to be announcing how they're going to monetize the asset side of the U.S. government's balance sheet. Well, if you look at the U.S. government's financial balance sheet, the U.S. government has enormous non-financial assets, properties, the Navy, the military. But when it comes to financial assets, the kinds of things that you can monetize, I mean, you can monetize non-financial assets by selling them off. And he may well plan to sell off certain things like Puerto Rico or national parks or government buildings to raise money. That is not necessarily the smartest thing to do when you're facing enormous deficits and enormous debt. You're selling your capital stock to pay for your current account deficit. And while we're at it, let's just talk about it. The current account deficit for the current fiscal year is estimated to be about $1.8 trillion. It actually will be larger than that because some of the policies that are being put in place now will increase government deficit spending, at least in the short term. And total debt as of today is put at $36.2 trillion. That's important when it comes to gold. So when they talk about monetizing the asset side of the U.S. government's balance sheet, there's not a lot to monetize that's financial. The only real asset financial asset that the U.S. government has is the 261 million ounces of gold that the Treasury owns. Now, there are other things you can do. You hear people all the time talk about the unfunded liabilities of the U.S. government over the next 10, 20, 30, 50 years. Those people are demagogues. They never talk about the projected U.S. government revenues over the same period of time. So they're looking at gross long-term liabilities, but they don't look at the gross long-term earning power of the U.S. government. That's not good economics or finance. But then those people only say that they're good at finance. They actually aren't, right? So you could talk about monetizing those long-term assets that the U.S. government has, but that also doesn't make sense. Then there's now talk about revaluing gold, at least on the Treasury. There are people within the administration who are talking about, hey, why do we have gold valued at $42 an ounce, the 261 million ounces? We should market to market, as other central banks do. Other central banks usually don't actually market to market. They will use like 80% or 90% of the market value, understanding that if they tried to sell some, they could lower the price. And if you're going to lend out your gold, you're going to lend it out at 80 or 90% of your value, depending on your credit worthiness and your history with managing your gold and other monetary assets. So, the monetizing the asset side of the U.S. government is kind of like a joke. Hate to say it, but it is. Now, revaluing the gold from $42 to the market. Other people say, oh, well, the U.S. government's going to reset the gold price to $142,000 an ounce, and that'll solve the debt and deficit problems. That's utter nonsense. First off, the U.S. government doesn't set the gold price. The gold price is set in the world market on a constantly changing basis. The U.S. government can say, well, we're going to value our gold at whatever, but that's meaningless to the market, and it's meaningless to what the government can sell its gold for if it were to sell or lend its gold. If the government were to lend its gold, it'd get 80% of the market value if it were lucky. And if the government were to sell the gold, it would get the market price, but the market price would fall sharply because the U.S. government's selling 261 million ounces or some portion thereof. So you can't just willy-nilly say, this is what my gold is worth. That's what private equity companies do, and it's nonsensical. And Warren Buffett has spoken much more eloquently and nicely about the myths of private equity valuations. As part of the problem that we have not with the U.S. government's debt and current account, but with the accounting of private equity and corporate entities around the world. If the government revalued its gold to market, and would represent 5 months of the current deficit, it would represent 2% of the current debt. In other words, the gold is pretty much meaningless in terms of trying to solve the U.S. government's debt and deficit issues. The solution is obvious. Stop spending so much money and that you have to borrow more and go further in debt. But Americans prefer finding magic pills to fix their ailments. Oh, I don't want to exercise. I don't want to eat healthy. I'll just take this shot and it will cause me to lose weight. I don't want to do those things that will cause me to cease being diabetic or pre-diabetic. I don't want to do those things that are going to cause me to not get lung cancer. I'm going to look for some magic pill to solve it. And it's not just with medical problems that Americans have this lassitude and inappropriate passion. They also think about it, oh, how can we solve the government's debt? Well, you're not going to solve it with gold. Gold will not rescue the U.S. government from itself. It's just not. Even at 261 million ounces, the biggest stash of gold in the world, it's not going to solve those problems. So that's where we are. My reading recommendation, and it's an easy one because it's a graphic novel. It's different. It's fuller than the movie. I think the movie came out in 2005. The movie was great, and it was great for the moment, 2005, when there were any number of people who were betting that the George W. Bush administration would not have an election in 2008. Things were really bad in 2005. They were headed toward getting worse in 2007 through 2011. And V for Vendetta was made into a movie, which was really good. The novel, the graphic novel, is much different, and it's a much fuller story than the movie. It was written between 1981 and 1989 in England at a time when first the Thatcher administration and then Labour government were basically crashing the United Kingdom's economy and society. And it made sense then, and it makes sense now. It's extremely timely to read. So that's my book recommendation of the week. Gold prices. Gold prices have now broken above $2,900 just in the last 2 days. They have gotten up, they're about $2,927 as I speak. They had gotten up to about $2,974. CPM Group has been talking about the potential it will rise to 3,000 or 3,050 over the first quarter before the price comes off. What we're seeing is investment demand. It's investors around the world reacting to the Trump flooding the zone. There's so much uncertainty and destructive suggestions, the economically destructive suggestions, from tariffs to dismantling various critical parts of the government's financial support system, and there. And there are problems in other parts of the world, from Russia to Gaza to the Southeast Asia. So there are a lot of problems, and investors are buying a lot of gold right now, pushing the price up. Some of those investors are speculators who are drinking the Kool-Aid about London running out of gold. I talked about how the arbitrage works and how the arbitrage flows both ways. That's true. But a lot of investors are buying gold because they're looking at what the Trump administration is planning to do, and they're saying, this is recessionary, this is inflationary, this is bad for my bottom line, it's bad for the U.S. economy, it's bad for the global economy, and I want to own gold. That will probably continue at least for the next few weeks, probably through the first quarter. Then we expect the price to come off, maybe stay above 2,600, maybe stay above 2,400, 2,500 in the middle part of this year, before rising again later in the year as investors' concerns about all of these political and economic problems wax and wane. Similarly with silver. Silver prices have risen. They've gotten up to about $33. As we speak, they're $32.30. We're seeing a lot of increased volatility in gold and silver prices. That's probably going to continue. You have a very active March COMEX silver contract. There'll be a lot of March futures contracts rolled forward into May and further into July over the next 2.5 weeks as we move toward the first delivery date at the end of February. So there are upward pressures on silver that could take the price up to $35 on a short-term basis over the next 2 or 3 weeks. Then we would expect the price to come off once we get into March. And then there's that seasonality, and there's the waxing and waning of investor concerns. We think the price will probably stay above $28 over the course of the second and third quarters, and then probably move higher later in the year. We will be having our Silver Facts and Fantasies online seminar. This is something we started in 2021 during the lockdown and the post-lockdown period. It's a free online seminar. We'll talk about silver, supply, demand, price, talk a little bit about what we expect, what we see going on, and what we expect to go on over the course of 2025. And then there's an open question and answer period. You can go to our website to this link and sign up to participate, to listen in, and we will have this open question and answer period. In addition to that, people who sign up and attend will get a free report, about a 30-page report that will review what we talk about in terms of the supply and demand outlook for silver, as well as the price. I think that's all I have for now. We'll be coming out with our gold yearbook in the late March, silver yearbook late May, platinum group metals yearbook in late July, and we'll be up at the PDAC, both doing the Silver Facts and Fantasies video and hosting our 21st annual silver reception. Take care of yourself. take care of those around you. If you want, you can go to our website. There are a lot of free reads and videos there. There are also things that you could buy. You can pre-order our 2025 yearbooks. You can buy our 2024 yearbooks. You can look into subscribing to the Precious Metals Advisory. You can look into our retail investment program. And you can send an email to us at info@cpmgroup.com saying that you want to talk to us about how we can help you better manage your exposure to precious metals and commodity prices. I'll talk to you on Friday. In the meantime, try to do something good for the world.